In macro markets, there's a lot going on. A relentless flattening the yield curve, composition of the Fed issues, inflation, still, is it missing or not? A 30-year rally in the bond curves, is that over? In order to determine which one's going to be the most important, what's going to determine bonds to break, the most important element by far is whether wages are missing or whether they actually start to re-accelerate. A lot of people across markets, a lot of researchers, a lot of central banks are starting to question not only the shape of the Phillips curve, but indeed whether wages will ever pick up again. If wages do pick up, the investment implications are very, very significant. Bond yields will rise significantly. We'll see big rotations across the composition across equity markets, rewarding the search for yield will come increasingly under question. And people will begin to wonder whether the central bank is actually still ahead of the curve or well behind the curve. So in order to answer the question, we've done quite a lot of work on this, or I've done quite a lot of work on this in terms of redoing the models, investigating the core themes and going back to basic principles. The really interesting aspect about the last 12 months is at this time last year, markets were pricing secular stagnation. Markets were believing there wasn't a cycle. We bring the clock forward to today, and what's very clear is that global growth is now knocking on the door of 4%. Wages are rising in the US, somewhat slower than perhaps others would like, but importantly, the Phillips curve doesn't appear to be dead. The gap, the unemployment gap, the gap between full employment and where the unemployment rate is, has already been exceeded in the US, and indeed in a lot of other industrialised economies. In the case for Australia, we've seen if the unemployment rate continues to fall at the same rate for the next 6 months that it has in the past 6 months, even Australia will be through its full employment level. The really important aspect from our modelling point of view is that wages gap, or the unemployment gap, is still an important variable. It's just not the only variable that's important for wages. Margins, inflation expectations, and importantly, and this is something that's not in the models and not in the research and not in the literature that we think is very important, the accommodation of both the baby boomers and the millennials into the labour force simultaneously has been a very important structural issue that has lowered wages over the last 7 to 8 years. The really important aspect is that's now starting to go away. And in Australia's perspective, both margins, inflation expectations, and indeed the unemployment gap are telling us that wages are actually going to pick up reasonably significantly over the next 3 to 4 quarters. In the case of the US, it's well entrenched. In the case of other parts of the world, we think it's reasonably well entrenched as well. Wages are almost certainly going to pick up over the next 12 months. If that's true, then the implications for bond yields is also that this relentless flattening, the 30-year rally in bonds, is not only over, it's likely to surprise not only markets but policymakers as well. So there is a very good chance that as we move into the middle part of next year, questions will begin to be raised, is the Fed actually behind the curve? And indeed, what does the next 30 years look like for bond yields in comparison to the prior 30 years? From our perspective, it's a super important event. That's a big transition, it's a generational transition for bond markets.